Mortgage interest isn't always tax deductible. Surprised? Most people are. But here's the thing. It all depends on a few key factors, like how you file your taxes, the type of loan you have, and even when you got your mortgage. I'll break this down so you can avoid these costly mistakes and potentially save big on your taxes. Hi, I'm Kevin Martini, certified mortgage advisor with the Martini Mortgage Group. And if you're buying a home, refinancing, or just simply trying to understand how your mortgage fits into your financial picture, then you're in the right place. Stick around, and by the end, you'll have a crystal clear understanding of when mortgage interest is and isn't tax deductible. Let's start with a big question. Do you itemize your tax deductions? Because if you don't, you cannot claim the mortgage interest deduction, period. For 2025, here's what the standard deductions look like. $15,000 for a single taxpayer, $22,500 for a head of household, and $30,000 for a married couple filing jointly. If your total deductions, including your mortgage interest, doesn't exceed these amounts, it might make more sense to take the standard deduction. But every situation is unique. Remember, I'm a certified mortgage advisor, not a certified public accountant. So work with your tax professional to discover the right call for you. Next, is your mortgage a qualified residence? This is a key requirement for deducting mortgage interest. Here's how it works. Your primary home qualifies, no questions asked. In addition, you can also claim one secondary home like a vacation home. However, if you're dealing with an investment property, that is a completely different story. The tax treatment for rental or investment properties follows an entirely separate rule. For those, check out IRS Publication 527. To help, in the description, I've included a link to IRS Publication 527. This one trips up a lot of people. To qualify for a mortgage interest deduction, your loan must be classified as acquisition indebtedness. That means the funds were used to buy, build, or improve a qualified residence. Here's the limits for acquisition indebtedness. For loans taken out after 2017, you can deduct interest on balance for up to $750,000. Now, for older loans, in other words, for home loans taken out before 2017, the limit goes up to $1 million. Let me share a couple Kevin Martini examples. Let's say you bought a $500,000 home with a $400,000 mortgage. You can deduct that interest because the mortgage was used to buy the property and falls within the $750,000 limit. Of course, assuming that you itemize. Now, if you paid cash for that home, then took out a $400,000 cash out refinance for unrelated expenses, I regret to share that mortgage doesn't qualify because it wasn't used to buy, build, or improve the home. Now, if you closed on your loan before December 16, 2017, you're in a slightly different game. Your acquisition debt limit is $1 million. And here's the good news. You keep that limit even if you refinance, as long as you don't increase the balance. Let's say you're refinancing a $950,000 loan. If your new loan amount doesn't exceed $950,000, you can still deduct the interest under the $1 million rule. And this applies even if you're consolidating pre-2017 home equity loans used for qualifying home expenses. Finally, let's clear one common misconception. Does this apply to investment properties? The short answer is no. everything I have shared, itemized deductions, acquisition indebtedness, and qualified residences applies to primary homes and vacation homes only. If you're dealing with a rental income or other investment property issues, I recommend you check out IRS Publication 527 or consult with a tax professional. Again, I have included a link for the IRS Publication 527 in the notes. If you feel overwhelming, don't worry. That's why I'm here. At the Martini Mortgage Group, we help homeowners and buyers navigate not just the mortgage, but how those mortgages fit into the overall financial strategy. If you're thinking about buying, refinancing, or just want to explore your options, reach out to me. Let's make your homeownership journey smooth and stress-free. My name is Kevin Martini, and I can be reached by calling 919-238-4934. Thanks for watching, and please share.